So let's compare the divisional comparison and residual income. So the residual income approach has a major disadvantage that it cannot be used to compare the performances of different sizes. So what does it mean? So if recall that the retail division of the Zephyr has average operating assets of 100,000 and the required rate of return was 20%. So they are generating 20,000 of residual. Sorry, the minimum recorded rate of return is 20,000, and assume that the wholesale division of Zephyr has an average operating assets of $1 million, and the required rate of return is 20%. So 200,000 is the required rate of return on 1 million operating assets. So how much they are producing the residual income? Zephyr is producing, the retail division is producing 10,000, and the wholesale division is producing 20,000, right? So the question is, which one we prefer, that whoever did the well. So the residual income number suggests that the wholesale division outperformed the retail division by 10,000 higher, right? So however, the retail division earned ROI 30%. How? So retail division ROI is equal to net operating income, which is here 30,000, and net operating assets are 100,000. So answer is 30,000 divided by 100,000, 30%. How about the ROI of wholesale? So the net operating income earned by wholesales 2,200,000, 220,000, sorry, and net operating assets are 1 million, right? So answer is 22%, right? So now here is the big clash between the ROI versus the residual income. So which one we prefer, or which one we go for? So if we base our argument on the basis of ROI, then we say that retail outperform the wholesales, as retail has earned 30% ROI and wholesale has earned 22% of ROI. But if we see the number game, that in residual income, the wholesales department wins the game, as it has earned $20,000, which is 10,000 more than the retail. So in that case, where ROI contradicts with the residual income one, it's better to choose residual income, right? So the other point of view is that the wholesale division residual income is larger than the retail division, simply because it's a bigger division. So when this kind of things happen, you may have now to think about that, how much actually the dollars are coming. So in that case, $20,000 are coming, which is income above than the retail one. Then you can say that, okay, it's a bigger department, so that's why we are earning a bigger number here. But in the terms of efficiency here, we can say that, oh, retail department is earning 30% than the wholesale department, which is earning 22%. Okay, let's start our learning objective 3, which is compute delivery cycle time, throughput time, and manufacturing cycle efficiency. So these are the performance evaluation measures of production department. So let's see further. So we have a quick check here that a TQM team at Norton Corporation has recorded the following average times for production. So we have wait time, inspection time, process time, move time, queue time. And what is throughput time? I'm just going to give you 5 minutes to solve this question, and then we're going to solve it together. Okay, so what is the throughput time? The THOO. The throughput time equals to inspection time, which is 0.4, plus move time, which is 0.5, plus process time, which is 0.2, plus queue time 9.3. The answer is 10.4 days. So the delivery cycle time is the time that is elapsed from when a customer is when the customer order is received to when the goods are shipped. So which is equal to the wait time plus the process time plus inspection plus move time, queue time, and goods shipped to the customers. So we call the process time plus inspection time plus move time plus queue time to throughput time. So throughout the manufacturing cycle time, the manufacturing cycle time, which is also called the throughput time, we just call the manufacturing cycle time. It is the amount that required to turn the raw material into finished goods. Like we process the raw material, inspect them, move to the other departments, and then queue time, right? So we call this manufacturing cycle time or throughput time. So, and the process time here, it is the only value added time here, that how much quickly you turn the raw material into finished goods. And then we have inspection, move out, and queue time, right? So after all these measures, so we can calculate the manufacturing cycle efficiency. So where we can say that the value added time divided by manufacturing cycle time. So since we call that the process time is a value added activity here, so we call this process time as a value added time divided by the manufacturing cycle time, which is throughput time, right? So the other extension for the same question is that what is the manufacturing cycle efficiency? And what is the manufacturing cycle efficiency formula? That is value added time, which is we call that the process time divided by throughput time, or the value added time divided by the manufacturing cycle time, which is throughput time. So just gonna give you 2 minutes, pause the video and solve it by yourself, and then we match the answer. So here it is. The process time is 0.2 days divided by throughput time total is 10.4. The answer is 1.92%. It means B is the right answer. The other quick check is that what is the delivery cycle time, which is when we receive the order and when the goods are ready to be shipped. So it means it is wait time plus move time plus inspection time plus queue time plus the process time, which is 0.2. So that would be 13.4 days. Answer is